There is a structural contradiction sitting at the center of the current inflation debate, and most investors are positioned on the wrong side of it. The public narrative says inflation is under control. Central banks have guided expectations toward normalization. Rate hiking cycles have peaked. The consumer price index has decelerated from its post-2021 highs. On the surface, the data appears to confirm the narrative. But capital is not positioned for normalization, it is positioned for persistence. Gold has held near multi-decade highs even as nominal rates remained elevated, a combination that historically produces headwinds for non-yielding assets, not tailwinds. Bitcoin has attracted sustained institutional inflows through regulated vehicles in a period when risk assets broadly faced significant valuation pressure. Real estate in supply-constrained urban markets has not repriced to reflect the full cost of financing. Commodity indices have remained structurally firm despite demand-side moderation signals. These are not random anomalies, they are a coherent signal. Sophisticated capital is not hedging against the inflation of last year. It is positioning against a monetary architecture it does not believe will produce durable price stability. Because the structural incentives that created the inflation have not been resolved, they have been deferred. The dislocation is this: the narrative says the problem is solved, the positioning says the problem is paused. To understand why capital is behaving this way, you need to analyze the liquidity environment, not the headline rate, but the net liquidity condition across the full monetary system. The first macro force is debt rollover pressure. Global sovereign debt issuance reached historic levels during the 2020 to 2022 fiscal expansion period. That debt is now maturing on a rolling basis, requiring refinancing at significantly higher nominal rates than when it was originally issued. The United States alone faces trillions in Treasury refinancing needs on a multi-year horizon. This refinancing creates structural demand for accommodative monetary conditions. Not because policymakers prefer inflation, but because the alternative produces fiscal dynamics that are politically and economically untenable. Observation: sovereign debt loads are historically elevated. Interpretation: the incentive structure favors financial repression, holding nominal rates below the true inflation rate to erode the real value of outstanding debt. Probabilistic implication: the likelihood of sustainably positive real rates over a multi-year horizon is constrained by the debt service math, regardless of stated policy preferences. The second macro force is monetary base expansion across non-US jurisdictions. While the Federal Reserve conducted quantitative tightening through 2022 and into 2023, the People's Bank of China, the Bank of Japan, and the European Central Bank maintained or expanded their balance sheets at various points during the same period. Global net liquidity, aggregating central bank balance sheets, reverse repurchase agreements, and Treasury general account dynamics, did not contract as sharply as US-centric analysis suggests. Capital that is globally mobile tracks global liquidity, not domestic liquidity in isolation. The third macro force is fiscal dominance, the condition in which government spending decisions effectively constrain monetary policy choices. When fiscal deficits are large enough that tightening monetary policy would produce disorderly bond market conditions, the central bank faces a choice between its inflation mandate and systemic stability. Historically, systemic stability wins. The structural implication is that monetary policy in fiscally dominant environments tends toward accommodation over time, even when the stated framework suggests otherwise. These three forces, debt rollover pressure, global liquidity persistence, and fiscal dominance, define a liquidity environment that is structurally inflationary in its long-run bias. Even when short-run CPI readings decelerate, the structural condition persists. Assets with fixed or shrinking supply carry a tailwind that short-term rate of change metrics do not capture. Sophisticated capital is not waiting for the next inflation print to confirm its thesis. It is positioning structurally, ahead of the liquidity conditions it expects to materialize. The first observable positioning signal is gold reserve accumulation by central banks of emerging market economies. Central banks in China, India, Poland, Turkey, and across the Gulf Cooperation Council have materially expanded their gold holdings over the past several years. The incentive behind this behavior is not speculative. It is structural diversification, away from dollar-denominated reserve assets in a period when the weaponization of dollar reserves has demonstrated that counterparty risk in sovereign holdings is not theoretical. Central banks are buying gold not because they expect it to produce yield, but because they are reducing concentrated exposure to a single issuer's monetary decisions. Observation: sovereign reserve managers are structurally reallocating. Interpretation: the reserve currency diversification trend has institutional momentum and a clear incentive logic rooted in geopolitical risk management. Probabilistic implication: sustained demand from reserve managers creates a structural buyer of hard assets that is not price-sensitive in the short term. The second observable positioning signal is the behavior of Bitcoin ETF flows following the approval of spot Bitcoin exchange-traded products in the United States. The inflow dynamics observed in the initial months of these products demonstrated institutional demand that was structurally front-loaded, suggesting that a cohort of capital had been waiting for a regulated, accessible vehicle rather than forming conviction in real time. Corporate treasury allocations to Bitcoin, while still concentrated among a small number of firms, have grown beyond their initial proof-of-concept phase and now represent a documented, recurring corporate financial strategy for balance sheet inflation hedging. The third observable positioning signal is stablecoin supply dynamics. Periods of stablecoin supply expansion have historically correlated with increased on-chain activity and a buildup of dry powder positioned at the margin of risk assets. Periods of stablecoin contraction have correlated with capital exit and risk-off conditions. When stablecoin supply is stable or growing in an environment of macro uncertainty, it suggests capital is not fully exiting, it is waiting for clarity before repositioning into risk. These three signals tell a consistent story. Capital that manages large mandates is not positioned for a world where the inflation problem is durably solved. It is positioned for a world where the monetary architecture continues to erode the real value of fixed income instruments over time. Beyond institutional flows, the behavioral and derivatives data layers provide a more granular view of market structure and where risk is concentrated. The first derivative signal is funding rate behavior during periods of price appreciation. In a structurally healthy uptrend, funding rates tend to remain moderate even as prices rise, reflecting a balance between leveraged long demand and natural short-side hedging activity. When funding rates become persistently elevated, it signals that leveraged long positioning is outpacing structural demand, creating a reflexive dynamic where price appreciation is increasingly funded by borrowed conviction rather than real capital inflows. Monitoring whether funding rates confirm or contradict spot price action is a basic but consistently informative signal about the sustainability of price moves and the concentration of liquidation risk above current levels. The second derivative signal is open interest relative to market capitalization. Rising open interest in a period of flat or declining prices signals that leveraged positioning is building without a corresponding catalyst, a condition that historically resolves through a volatility event. Declining open interest during a price recovery, by contrast, suggests the move is driven by spot demand rather than leverage, a structurally more durable signal. The first behavioral signal is the HODL wave distribution, an on-chain metric that tracks the age of unspent Bitcoin outputs to identify whether long-term holders are distributing or accumulating. Extended periods during which the proportion of supply held for 12 months or longer is growing suggest that the cohort with the lowest time preference and the highest conviction is not selling. This creates a supply shock dynamic. Circulating supply available for purchase compresses at the same time that institutional demand channels are expanding. The second behavioral signal is exchange reserve trends. When Bitcoin balances held on centralized exchanges decline persistently over time, it indicates that holders are withdrawing their assets into self-custody, removing them from the immediately available sell-side supply pool. This structural reduction in exchange-held supply, when combined with steady or growing demand from institutional vehicles, creates a convex setup. Demand changes at the margin produce larger price effects because available supply is structurally constrained. Consider this: when supply is constrained by long-term holder behavior and exchange reserves, while demand grows through regulated institutional vehicles, the distribution of outcomes over a longer horizon is not symmetrical. The downside is bounded by the structural cost basis of existing holders. The upside is unbounded in nominal terms in a monetary environment with no hard ceiling on money supply growth. That is the definition of convexity, and it is the structural logic behind why hard assets with fixed supply are rational inflation hedges, independent of short-term price behavior. The analytical picture above does not translate into a trading directive. It translates into a positioning framework. The first principle is separating short-term volatility from structural trend. Inflation hedging is a multi-year thesis, not a quarterly trade. Assets that hedge against monetary debasement do not produce smooth, linear returns. They produce volatile, cyclical, and sometimes deeply negative interim drawdowns on the way to structural outperformance. A position sized correctly for a multi-year thesis is one that can be held through those drawdowns without forced liquidation. A position sized beyond actual volatility tolerance will be sold at the worst possible moment, converting a long-term structural advantage into a realized short-term loss. The second principle is layering exposure across the liquidity spectrum. A rational actor in an inflationary monetary environment does not concentrate all capital into a single inflation hedge. They layer a deep reserve in hard assets with high conviction and low time preference, a liquidity buffer in stable instruments sufficient to absorb short-term operational needs, and a smaller allocation to higher volatility asymmetric instruments where convex upside justifies the drawdown risk. Each layer has a different purpose, a different time horizon, and a different liquidity profile. Managing them as a single portfolio rather than as distinct layers with distinct functions is a common structural error that produces suboptimal outcomes across all three. The third principle is mean reversion awareness in hedging instruments. Gold, commodities, and Bitcoin are not immune to cyclical mean reversion. Periods of significant outperformance relative to broader assets are typically followed by consolidation phases, during which the hedge underperforms on a nominal basis even as it continues to perform its structural function. Maintaining the discipline not to exit a structurally sound position because its short-term narrative has turned negative, that is a core behavioral competency for anyone pursuing long-duration inflation protection. The fourth principle is monitoring net liquidity, not headline rates. The Fed funds rate is a policy signal. Net liquidity is the operational reality. These two measures have diverged meaningfully at multiple points in recent monetary history, and the divergence has consistently predicted asset behavior more accurately than the policy rate alone. Capital that anchors its positioning to net liquidity rather than to rate headlines operates with a structural informational advantage. The monetary environment does not reward passive holding of depreciating currency. It rewards deliberate allocation into assets whose scarcity is structurally enforced. Whether by geological constraint, energy expenditure, or cryptographic protocol, each form of enforced scarcity carries its own risk profile and durability across different monetary scenarios. Understanding why each of those constraints exists and which of them is most durable is the analytical work that separates structural positioning from speculative noise. That is the framework. The environment will continue to provide signals. The discipline is in reading them correctly and acting without emotional distortion. 21 Protocol, Capital Intelligence, Strategic Resistance, System Exposure.